And a warm welcome to today's special event. My name is Joy Jacob and I will accompany you through today's event as a moderator. Nice to have you with us this Wednesday afternoon. Meme stocks are hype stocks that are characterized by large price jumps. Usually the share prices are fueled by social media such as TikTok or Reddit. Examples of particularly exciting hype stocks are GameStop, AMC Entertainment, and Palantir. Investors who find the right time entry point can generate high returns. But what should you watch out for? Which meme stocks are particularly exciting, and what do investors have to consider when betting on meme stocks? In today's online seminar, we will answer these and other questions about the topic of hype shares. An investment professional analyzes how meme stocks affect the stock market, how investors should react to them, and how you can track down promising stocks. With that, I introduce today's guest. Hello and welcome, Phil Mackintosh from Nasdaq. Welcome to this finanzen.net seminar.
Thanks for having me, Joy.
Before we start with the presentation, I would like to point out the following to our dear viewers. If you have any questions or comprehension problems, you can contact us anytime during the seminar using the chat function. I will possibly take up some of your questions directly and pass them on to our expert. At the end of the event, we will clarify any open questions together in the question and answer session. Phil, you are Nasdaq's chief economist. What else should our viewers learn about you?
Good question. I mean, I've spent my life on the sell side and the buy side. I've managed money and I've built algorithms. So I've spent a lot of time learning how trading works. And sitting at Nasdaq, I guess I have a pretty interesting and unique job because I get now to talk to all the people building algorithms and doing trading, all the retail broker dealers, but also all the issuers that we have at Nasdaq. So all the interesting companies like Apple and Amazon that are listed on our markets, and help them understand how their stock is trading as well.
Thank you. And now we can get started right away. Phil, are you ready?
I'm ready. Just need to share my screen.
Perfect. In that case, I will give you the moderation rights right away. You should have the pop-up right now.
Mm-hmm.
And we can see your screen now.
Okay, excellent. All right, so let's get started. We are going to do a little bit of an introduction to what's been going on in a macro sense as well. Before we get into the details of the meme stocks, just because I think it's important to understand how macro and how COVID has helped to drive, I guess you could say, the meme stock characteristics that we've seen. And so if we wind the clock back to COVID and we look at the big sell-off that we had, we remember how COVID impacted economies. Obviously, a lot of countries went into quarantine. In the US, 50% of employees weren't working for a number of weeks. 50% of businesses were closed down, and we all had to try and work out how to deal with COVID. But at the same time, governments came out with rescue plans. And so you can kind of see the different impacts of COVID and the rescue plans just in the stock market performance. Obviously, China, which is the red line here, was one of the first markets to get COVID and to get COVID under control. And it had the biggest recovery or the strongest recovery early on, but it's actually already started to turn, and China has started to focus on other things because their economy is kind of back to normal and has been for a while. If we look at the US, you can see it's outperformed Europe pretty significantly, and there's a lot of reasons for that. Part of it is US has probably dealt less severely with quarantines, but also they've had a lot more stimulus, which you'll start to see in some of the economic data. And I think the difference in the stimulus and the difference in the performance of the US market's important to this topic too, because obviously the meme stocks seem to be a US only phenomenon. Given where the stock market is, this chart on the right is kind of interesting because it's talking about valuation, and we're obviously at or pretty close to all-time highs now. So a lot of people have been asking for a while, especially with COVID still around, is the stock market overvalued? And when you look at all of the dots in this chart, what you're seeing is the interest rate on the horizontal and the price earnings ratio, sort of a valuations multiple on the vertical. And what you see is as interest rates go down, you actually see the PE multiple go up. So the actual multiple that makes the market, I guess, fairly valued seems to go up. And that makes sense from a valuation perspective. It makes sense from an interest rate cover perspective. So if you're a company and interest rates go down, you actually make more profit because you're not paying as much out in interest rates. If you're thinking about it from a valuation perspective, obviously the earnings into the future are going to be worth more in future dollars if interest rates are low and inflation is low as well. And so growth companies tend to perform really well when interest rates fall because those future earnings don't need to be discounted by as much. One of the interesting little subcomponents of this chart is all of the purple dots. If you look at the dates in here, this is the tech bubble. And so clearly in the tech bubble, we had a lot of companies with not much earnings, pretty high price earnings multiples, so high prices, low earnings. And you can see, I guess we know in hindsight that wasn't sustainable, but you can see in the chart just how different those valuations were than everything closer to the gray line. And where we are right now is around about this orange dot. So we're a little bit above the gray line, but because rates are so low, and actually rates have been falling again in the US, we're staying pretty close to that gray line. So we're not really expensive, which is the short. If we look at what's been going on by sector, there's also a few interesting trends there. So we can see that tech stocks, obviously working from home, using Zoom on a daily basis. My daughter seems to be doing a lot of Roblox and gaming. All of the chip stocks, all of the cloud compute stocks have been doing really well. So tech was very well positioned to benefit from COVID. And you can see it recovered the fastest, but it has actually slowed down a little bit since we got through the vaccine announcements. And that's a really important point because you can see once the vaccine started to be distributed, stocks in the energy complex, in the financials complex actually started to outperform because people were betting we would be back to normal on aeroplanes. Rates would be going up because everybody would be sort of back to work again like normal, and banks would start to earn some more money. The Fed wouldn't need to hold rates down so much. So you can kind of see some different patterns in the immediate sort of stimulus period and then in the post-vaccination period, just in terms of what people were buying, what companies were outperforming. Ironically, healthcare, which did perform very well because it was a healthcare problem, has not performed so great since we've been muddling through COVID pretty consistently. And that's because it's really only the vaccine companies that have done well. A lot of other companies have kind of been held back, especially with healthcare. Voluntary healthcare is something that a lot of people have put, I guess, a hold on. And so healthcare itself has not done as well as you might think. But from a sector perspective, it was interesting to watch ETF flows, which this table on the right shows. We were actually looking at what ETFs were active in the sell-off period, which we've marked here in red, and in the rebound period, which we've marked here in green. And what we did was we looked at stocks that had a huge amount of assets growth. We looked at stocks that traded a lot more volume than normal, and we looked at stocks that had good price returns on the right-hand side. And we kind of scored all those three factors together to form a rank here. And so what's interesting is you see the JETS ETF is first and third. It was very active on the way down as the energy complex sold off, as people stopped doing business travel, stopped doing any forms of travel. JETS, which is obviously an ETF that's a complex of global airlines, really fell a lot. You can see that from the performance, and people were actually buying the dip. You can see that from the asset growth. When the market started to rebound and we started to work out, if you could mask up, you can get on planes and ways to deal with it, JETS became a bit of a recovery play as well. And so it was still very active, still had assets growth, and actually had some bounce in performance. But you see some other factors in here as well. And generally what you see is just a lot of really thematic trades people are using ETFs for now. But things that we talked about already, cloud computing, online retail, as segments of the market that are going to benefit from COVID and work from home. Stocks like the energy and oil equipment sectors really heavily traded as well, often buying the dips. You can see assets actually growing in those sectors as well, and on the way up, sort of buying the recovery trade. You can see a few other thematics in here, MLPs and oil funds against the energy complex, but home construction. In the US especially, we saw a lot of people moving out of cities into suburbs, building extra rooms so that they could actually work from home. And so there was a lot of home construction, home builders trades that were going through. So it was kind of interesting to watch the ETF complex, a lot of really sophisticated investors, a lot of really good ideas, and a lot of ETFs that make it easy to put trades on in a diversified way, but in a very thematically focused way. So if we look a little bit at the macro and the recovery from COVID-19, I think the first thing that really stands out is just the amount of stimulus that pretty much every country has put behind the shutdowns and the quarantines. And I guess Europe has put in almost 10% of GDP in terms of its stimulus, but that pales into comparison with some of the other countries, especially North America. You've got Canada and US again with the new administration here, just a huge proportion of the average GDP being put back into the economy as stimulus. And that explains to me a lot of why the US economy has recovered faster and the market has recovered faster too. There's a lot of money in the US system. If we look at the GDP on the right-hand side here, you can actually see the US, early on, we were talking about whether we would have a V-shaped recovery or a tick-shaped recovery or a W-shaped recovery. We pretty much have had a V-shaped recovery. In the US, we have GDP back above pre-COVID levels, and so we've recovered pretty quickly. Europe is still a few percent below, but it's recovered pretty quickly as well. Compared to other recessions, obviously a really deep recession, but a really quick recovery thanks to the stimulus. But the stimulus and I guess the way that people and consumers have dealt with COVID has definitely not made all business recoveries equal. And if you look at the data, there's a really interesting, they talk about a K-shaped recovery in the US, but there's a lot of places where you can see winners and losers. And the most obvious is to compare goods and services. So the goods sector, which obviously you can do pretty easily with stimulus money, you can buy products, they can get delivered to your house and you can open them, recovered really quickly. Within a couple of quarters, it was back above pre-COVID levels, and it's actually kept growing and is now strongly above pre-COVID levels. So the manufacturing sector, you look at factories, you look at imports, are all really strong and actually above pre-coronavirus level. Retail spending, really strong. The problem is, you can see by the height of goods on the chart and the axis on the right-hand side, services in the US is a much bigger part of the economy. So the fact that services has not recovered as quickly is important for the employment situation here. It's also important for just the overall strength of the economy. And so I guess the outperformance in the goods sector is offset pretty significantly by the underperformance in services. And with COVID lingering, you can see that services has really lagged. If you think about who's in the services industry, the chart on the right-hand side, you can see here some winners and losers by segment. And so airline industry, cruise industry, movie theaters, a lot of leisure and hospitality, restaurants, which are actually really big employers, but service sector industries are especially badly off and are still not anywhere near fully recovered in large part. You look at some of the retail segments, discount stores, video games, especially if retail had an online presence, they've actually done even better since COVID. So really the stimulus checks and all of the money in the system has picked winners and losers, and there is still a big difference in terms of which companies are doing well and which companies are doing badly. Although as you see benefits or I guess gains in COVID and gains in vaccinations, you see some rotation around sectors too because of that. I talked briefly about the retail spending. So this chart on the left, it really does put it in perspective. The impact of the timing of the stimulus checks. We had stimulus checks last summer. We had stimulus checks around Christmas time as well. And you can see each time the stimulus checks were deposited in people's accounts, a huge increase in retail spending. That's left retail spending at elevated levels, like we said, which is part of the reason that the manufacturing sector is going so well, but it has started to plateau. So that's important if you're thinking about what stocks you're looking at for the future. Retail spending is slowing now. On an after inflation basis, it's actually falling, and people's stimulus checks are now largely being spent. So there's no new stimulus on the horizon, and the stimulus or the money that's been banked is starting to fade. But if you're a manufacturer, what you found is just a huge amount of demand for products, a huge amount of increase in imports, stress on ports, stress on the supply chain. And so a lot of charts look like this, where you can see inventory levels have fallen significantly, well below normal levels. That's put a strain on, like we said, imports, on the port facilities. You can see if you look at some of the data, shipping rates and just transporting things to a US or anywhere around the world really have shot up. And when I go and talk to issuers, these are the sorts of conversations that companies are having with me. They're all noting that shipping products onshore is costing a lot more than it used to. Input costs for the machinery that they need to make the products that they're going to sell domestically are costing a lot more. So you see the chart on the right. There is definitely inflation in the input prices and the costs of doing business, which I guess you would expect to squeeze margins eventually. But right now, it looks like we've actually been able to sort of transfer some of those increases in costs to increases in selling prices too. So it's helping to drive inflation at the consumer level. Of course, then we got to the point where vaccines were approved in the US. That was late last year. And what's interesting when you look at the data is as soon as the vaccines started to roll out, consumers started to change their behavior. So travel and transportation picked up from where it had stalled out really in the pre-vaccination period. Going to sporting events, going to Broadway this week has just reopened in the US. Restaurants and seated diners actually got back to pre-COVID levels because everybody was starting to feel comfortable with the vaccinations. They're starting to feel comfortable sitting closer to people that they didn't know. And all of a sudden, all the service industries started to pick up. So we had a huge amount of demand for jobs. We had a huge amount of unmet sort of supply where the labor force wasn't actually coming back into the labor force as quickly because a lot of these service employees either had school kids that still couldn't go to school and so they had to stay home, or they just weren't comfortable yet going back into a workplace where they weren't sure who was vaccinated, who wasn't, whether they were putting themselves at health risk, and yet the consumers were coming back. And so what's actually been happening, and again, this is something that issuers and companies have been talking to me about, is wages had to rise. And especially in that leisure and hospitality and retail sector, you can see wages have actually been rising pretty quickly. Early on, we had the manufacturing and construction industry with strong wage gains, but since we've had the vaccinations, we've seen the sort of pivot to services, the demand for services employees, and the shortages of service employees increasing too. And so again, that's squeezing margins. It's making companies need to put prices up, which itself is leading to inflation. And in the US, that's exactly what we're seeing. So if you look at the inflation, and we got new inflation numbers last week, it's hovering around pretty long-term high levels. The Fed prefers to look at core inflation because things like food and energy tend to go up and down when there's shortages or droughts, but they correct themselves. Whereas, and if you look at core inflation, this reading here is still the highest since around about 1991. So even excluding sort of the headline inflation, which includes some of the short-term prices that have rallied, some of the recovery in prices for things like hotels and airlines, what the Fed's calling transitory inflation, the core inflation still looks like it's pretty high, and it's staying pretty high at the moment, although it is starting to fall right now. Even talking to corporates and looking at the mentions during the last earnings season of inflation, you can see corporates are definitely more concerned. They're concerned with shortages of product, concerned with shortages of labor, the fact that wages are going up, the fact that their input prices are going up or their input costs are going up. They're having to put prices up or their margins are going to be squeezed. And what we've seen from the margins is companies are actually maintaining margins. Profitability has been good. So the recovery in corporate profitability has been really good. But that gets me into the meme stock frenzy. And really, let's start in 2020. And again, let's wind ourselves back to what happened with all of the stimulus checks and all of the sort of COVID shutdown. So what's interesting is the stimulus checks actually increased personal income, not just in the US, but around the world. And also, most of us working from home, or a lot of us working from home, actually meant we had less money being spent on things like holidays, on things like hotels and airlines. And so we started saving too. The gap between the income and the spending actually increased people's net savings. And so globally, there's estimates that put this number of increased savings above $3 trillion, just a huge pocket of extra savings in pretty much ready currency to be spent on things. And so one of the things I guess people could spend it on is stocks and investing in stocks. And what's interesting in the US is something else happened before COVID lockdown. We actually had I guess you call it a fee war on the retail broker side, where commissions went down to zero. And as retail investors saw zero commissions, you actually saw an increase in the number of trades being done every day. So with frictions on trading, with the cost of trading falling, the number of trades that were being done were already starting to increase. Then we have the first COVID lockdown, and you start to see stimulus checks in people's bank accounts. You see a lot of excess savings because people aren't going on vacation. People have talked about the fact that people had extra time because they might not have even been working full time. And we saw an even bigger increase in trades per day. And so this is really a 2020 phenomenon where retail became a much bigger part of the stock market in the US. A different way to look at this, but it proves some of the same points, is aligning downloads of Robinhood software, which is one of the retail brokers with free commissions, with the savings rate, which obviously spikes when the stimulus checks came in. And so you can see those stimulus checks and downloads of the software very well synchronized, and it would appear that people get the money and are going to look for places to invest it in the stock market. Other things that sort of support that view is just looking at the net retail buying and selling historically. And so retail tend to be a net buyer of stocks, but not a very large net buyer of stocks. The US market trades well over $300 billion a day, so these numbers here aren't huge, but they're a small addition to stock holdings pretty consistently, but not all the time through time. What we've seen since the stimulus checks hit is a really big increase and a much more consistent net buy coming from that retail complex. And so you can see basically over $1 billion a day of net buying coming from retail. It's less than 1%, but it's definitely tilting the balance of supply and demand thanks to retail interest in stocks. When you look at different metrics and try and work out whether retail are a bigger part of the US stock market, it seems pretty undeniably that that's become true. So since 2019, which remember was the year that we went to free commissions, you can see the proportion of stocks being traded by retail that are a percentage of all stocks trading has increased from around about 15% to now some people are estimating 24, nearly 25% of the stock market is coming from retail. What's interesting is a lot of the trading is actually happening in options too. So options have actually increased from below 15% to now almost 30% of on-exchange options are being done by retail. There's a few quirks with this because a lot of institutions might actually trade off-exchange options, but obviously retail is growing and they're using stocks and they're using options, and that's an important part of the meme story. But before we get there, I guess if you're a retail broker and you had your app open right now, with growth like that, you would have a confetti drop. And that is part of probably what has led to the meme stock trend. So let's get into it. When we look at what happened with the meme stocks, it's kind of interesting because no one really knew about meme stocks early in January this year. And one of the interesting things that happened on January 6th, you probably all know, was the US Capitol riots, the confirmation of Biden as the next president of the United States, and importantly, I think, is Twitter and Facebook banning some of the social media accounts that up until this point had been pretty active and had, I guess, involved a lot of people on social media intellectually and just from their time perspective on politics. And so all of a sudden, you can see that the social media impact on stock markets increased. The whole meme stock, the reason they're called meme stocks is, you know, it's a social media term. There was some Reddit threads where people were joining financial forums and speaking pretty eloquently about some of the stocks that they focused on in detail. And the social phenomenon created a lot of net buyers in just a small number of tickers. And I think that's really important. It really wasn't that much of the market. There are 6,000 odd companies listed in America. And the meme stock trend, or I guess frenzy, whatever you want to call it, was really just a cluster, a small cluster of mostly small cap stocks. But those few stocks for a couple of weeks made up 9% of all value being traded and 31% of all volume, so shares being traded. It helps that they were lower price stocks because it's easier to trade 1,000 shares of a low price stock than a high price stock, obviously. Takes less money. But we had just a phenomenal contribution to the market liquidity from a really small group of really small stocks. What's interesting is just as soon as it had started, most of it faded back away. And so this period in March, April, May, where there really wasn't much meme stock activity at all, except for in a couple stocks, GameStop being one of the really high profile ones. But then when we get back to June, you saw it pick back up again, and AMC, which is one of the stocks that Joy mentioned, became the new darling. I guess GameStop had been the first one, and AMC this time around was the stock that had the biggest increase in price, contribute a huge amount to the increase in value and the increase in volume that these basket of stocks made up in the market. So an interesting question is what happened in this period of sort of March, April, May? And one thing that happened was the price of Bitcoin doubled and then halved. And so again, this kind of fits in with the whole social media theme. People are talking about assets that are quite volatile, have a lot of potential for price movements, and people moving money pretty quickly from one segment to the other, from one asset class to the other. It really does seem like while the meme stocks paused, we saw a huge amount of activity in Bitcoin, a big rally in Bitcoin, and eventually the excitement there faded a little bit. And it looks like that timing came back with the increase in the meme stocks. So what do we know about what drove the meme stocks? In the first go round, so this is looking at January last year, one of the things that really drove the selection of stocks and the price rises was the fact that there was a short squeeze. So a lot of these stocks had short interest, well over 50% of their shares outstanding. In reality, the way that short interest works is for every new short, there's a new long. So it's actually possible to have more than 100% short because you've got more than 200% long. It's just the way that it's kind of like how futures work. You kind of increase open interest by having shorts involved. But these stocks were much more highly shorted than other stocks. And you can see within 2 or 3 weeks, the hedge funds that had shorted them, the investors that had shorted them, had mostly covered their shorts, and the shorts are back down much closer to normal levels. But in doing that, you had buyers from the retail side forcing prices up. You had short sellers then suffering losses from their shorts prices going up. Margin calls they had to cover, and one of the ways to cover that and reduce risk is to buy back their shorts, and that contributes to the buying, which makes the price go up more. It's a classic short squeeze. But the sophisticated investors pretty quickly normalized their positions, and they've actually stayed low since then. So when we came around to the second go round in June, what we actually found was driving the trading more was the fact that there's quite a lot of options trading, and specifically call options trading in the stocks that were meme stocks. We saw this in the first in the January meme stock craze as well, but it was a much bigger factor because it was really the only factor driving the craze in the second go round in terms of extending price gains. And the reason that happens is when you buy a call, you're obviously buying upside on a stock. The market maker will facilitate you in that trade, but there's delta. So you don't have to pay $100 for a $100 stock. You might buy a 20 delta call for $20. And when the stock goes up, the person or the market maker that facilitated that trade then has to hedge. And that's called a delta hedge. So as the price goes up, they have to buy more of the underlying stock in case they get called on the stock. And that means that the retail buyers are added to by the hedging from the options buyers. And then that makes the stock go up more, which means you have to delta hedge even more, which is called gamma hedging. And so call buying, it adds leverage to the system, and it makes some of these stocks trade and accelerate their prices pretty quickly. Especially knowing that they're less liquid stocks in the first place. And if you look at this, so AMC was trading in terms of premium on the options market far more than stocks like Tesla and Amazon, even more than the S&P 500 ETFs and index options were trading. So just a very concentrated trade in AMC, a very concentrated trade in GameStop as well, on the call side of that trade as well. And so they made up a huge proportion of the call market. you can kind of see just how much activity was going through these stocks. When you look at, this is just looking at one day in January. So the thickness of the bars here is the market cap. And obviously market cap, if there's more shares outstanding, if there's a larger company, there's more capacity to do more trading. But when you look at some of these small companies, they were actually trading more than $20 billion on the day of January 27, even more than Apple and Microsoft and Amazon, which remember were close to $2 trillion companies. So GameStop, AMC, BB really traded an exceptional amount of value, more sometimes than their market cap in one day. And you can kind of see that the point of the supply and demand for the stock ticker was clearly imbalanced, and it led to a huge amount of actual trading and volume in the system. I think from an investing perspective, we've got to be careful because a lot of these stocks now start to look rich. It's like the first slide we started talking about with the US market looking rich. You could go back to one of our charts early on as well, and on the left-hand side here, and say, well, movie theaters were one of those segments of the market that really got hurt by COVID. And with the vaccines rolling out, there's a lot of upside in movie theaters. So that's why I like AMC when I'm talking about it later on in 2021. But if we look at valuations for movie theaters on the right-hand side, all of these dots represent periods in time where a movie theater company had revenues and what its market cap was. And you can see they form roughly a diagonal. So more revenue equals more market cap or more valuation in a pretty linear way. AMC obviously had a huge reduction in revenues. That's why the dots have moved left. But with all of the trading and the price gains, their valuation has now stretched to the point where it's well off the historic diagonal line. The recovery in revenues that we're talking about to make this fairly priced is literally off the charts. And so that's got regulators focused. When regulators get focused, typically they go back and spend a whole lot of time and do research and come out with a big proposal. And that's what's happening right now. So we've seen things happen before where the regulators have come out and they've either changed market structure completely. They've actually gone after market manipulation and spoofing and tried to fine people. In some cases, people have gone to jail. But they've got to do a lot of research and they've got to get their facts straight before that will happen. And all of these kinds of things are going on right now. One of the things that's been proposed, or was at least proposed during the meme crisis, was whether stocks that rallied that fast should actually be stopped from trading, whether the amount of liquidity was a clear sign that something was disconnected and we should just stop and give everybody a pause, kind of like a market-wide circuit breaker. But when you look at the research, what you actually find is it's pretty common for a company to double in price in the space of a week. And so that's what all of these charts, all of these lines here are showing, companies that more than doubled in the space of a week. And what happened after that? And the colors are by deciles. So there's a tenth of the, I guess, tickers in each of these colors. What you see is over time, around about 50 or 60% of the stocks do fall, but not many fall all the way back to where they started before. In fact, only 10% fall back to below their pre-spike levels. So it's really hard to just say, oh, a company has gone up 100% a day, we should stop at trading. And actually, if we look at some of what was going on with the meme stocks, just because of the social media influence, stopping trading itself seemed to aggravate, I guess, some of the social media around the stocks. And people don't want to be restricted from trading. They think it's their right, and it probably is. One of the other things that regulators have been looking at is settlement, because the huge amount of liquidity in such a small number of tickers actually created a little bit of credit risk and a lot of potential exposures in that period between the trade happening and settlement happening, which is 2 days in America and 2 days in Europe as well. And so there's a lot of discussion to actually shrink settlement from 2 days after trade to 1 day after trade. At least that'll mean you've got your cash from the investors that have bought the stock. You can give it back to the people who sold the stock faster. From a market maker's perspective, their grossed up positions are smaller, and so there's less credit exposure in the whole system. From another perspective is just looking at the settlement cycle itself, and we talked about how at least in January, some of this trading was short squeezing. With shorts, even though you might think you borrowed a stock, an investor can sell it and then call back their shorts, and it can be hard to cover or to replace a short. And so what you tend to find when you look at shorts that fail, they fail in much larger quantities than other less shorted stocks. So highly shorted stocks, potentially we need a little bit more disclosure so we know what they are. We might want to know how concentrated positions are. And I think regulators are looking now at failed trades and just to see whether there's any risks in the system from failed trades. There's a few other things the regulator is looking at, and it relates to what we talked about before, the gamification of trading, the confetti drops, the apps that make it so easy, the free trading itself. If you look at some of the academic research, encouraging retail investors to trade too much might not actually be in their own interests, just because they tend to react emotionally to trades rather than buying for the long term. Sometimes they get sucked in and they buy high and then they sell low. And so investor protection has become a very, I guess, important buzzword for Chairman Gensler. And some of the things that they're looking at are how you protect investors, how you market to investors, and whether there is gamification and sort of over-encouragement of trading on the retail side as well. I think offsetting all of those factors. Yes.
I'm sorry, may I interrupt you real quick with a question? A viewer wanted to know if the scenario we just talked about, or you just talked about, was predictable, or if there were any signs which signalized it or made it predictable.
Yeah, I think if we go back, I guess, to the start of the meme stock, in hindsight, it might look more predictable. So I got to go back to this chart. This chart. I would say when we're sitting in the market in January, having watched the political cycle in the US, a rally like this in a small basket of shorted stocks like this was probably the last thing anyone was thinking of. We knew that retail was becoming a bigger factor in the market. We knew that the stimulus checks were probably driving it, that there was net buying coming from retail. But we didn't really, I mean, the market was rallying. So short sellers had mostly reduced their shorts over the time anyway. So as a whole complex, hedge funds that were dedicated short had reduced their net short. A lot of hedge funds have become more net long. So I don't think it was predictable, especially in the format that it took, which was just so concentrated on a few tickers, pretty small cap tickers as well, and driven by social media. Having said that, I think if we look back now and we see what happened in the political cycle in the US over the last 12 months, obviously, you maybe even longer than that, you sort of look at how important Twitter and Facebook and social media have become to forming political views and the bipartisan nature or the partisan nature of the political views in the US, the way that the election panned out. I think you can definitely see that social media has changed people's behavior pretty quickly. I don't think anyone could have forecasted it would change behavior in this way. And I think from a regulator's point of view, the fact that people are chatting about stocks online isn't the problem. The real question is whether there is like a formation of groupthink, which makes it really difficult to digest supply and demand in the marketplace. I mean, lots of fund managers would do a 1 million share trade in GameStop, but they would work it slowly over multiple days to make sure that no one saw them doing it. But when lots of little people do 1,000 share trades, it just creates too much supply and demand in a short period of time. And even market makers don't know what's going on, can't hedge those trades. And so it just makes it very difficult for the market to digest that kind of liquidity squeeze in such a short period of time. I hope that sort of answers the question.
That's perfect. Thank you so much.
So we got to there. I think, we obviously just talked about the fact that regulators are focused on a lot of things, that retail itself might not be educated enough to make their own decisions. They might end up doing themselves harm, that free commissions might be hurting. There's a flip side to that. And it actually speaks, I guess, to the question we were just asked too. And that is, it's really good to see retail investors, especially with the meme stock craze. It's been a lot of 20-year-olds and younger generation investors setting up new accounts, starting to buy stocks. And you can see in the data, the US households have typically been pretty underinvested in stocks, and it's starting to increase, and that's actually a good thing. And the reason that that's a good thing is when you look at the performance of stocks on the right-hand side, they far exceed the performance of bonds, which themselves far exceed the performance of housing, especially after the cost of owning a house. And so when you look at the mix of household wealth, typically younger people and lower income households are way over invested in houses and way under invested in stocks. I mean, the data here which show a lot of households are not invested in stocks, and that's the way to build long-term wealth. And so getting anyone into stocks is a good thing for the long term. It's a good thing for their financial future as well. And so that's kind of the flip side, and that's where, ironically, a lot of the Reddit threads have kind of highlighted to regulators, like, you can't stop me trading. This is, if enough retail investors buy stocks, it's actually good for lower income households to own more stocks. It's good for long-term financial security for more households to have more stock holdings. And so that's the flip side that the regulators have to balance as well. But speaking of risks and balancing, I thought I'd finish with just going back to the macro and talking a little bit about the two tail risks that are in the market as well. So getting away from meme stocks, but looking at retail investors that might be new to the market, what are the two things that could go wrong? Because we've had such a consistent rally. It's starting to come through in Europe now as well. We've got a little bit of a Goldilocks scenario, a lot of stimulus in the system, a lot of people coming back to work. We've got margins increasing and earnings increasing in stocks. You could say things look really good right now, especially with rates as low as they are and actually not going up that much. And so one of the risks is overheating. The reason that overheating is a risk is because if the economy does overheat, what we talked about before, the cost of inputs going up, the cost of wages going up, means the cost of prices go up. That actually means the real return on bond holdings goes more negative, which has distorting effects on asset allocation, but especially on people that own bonds and the income that they're actually going to accrue for when they do retire or when those bonds mature. You kind of need to slow the economy down a bit too to stop the inflation from getting out of control. And one way to do that that's pretty common these days would be to increase interest rates, slow some of that investment spending, slow some of that excess consumption, and bring things back into normal. And so the reason that's really important is if you look at periods where rates were falling in 2019, 2020, on the right-hand chart here, you can see this chart on the left is looking at returns in the stock market. So we had positive returns, the little diamond there, in the stock market in 2019 and 2020, mostly because of this yellow color, which is PE multiple expansion. It's that chart we looked at before with the sort of curve and all the dots going through it. But as interest rates fall, stock valuations go up. The stock valuations didn't go up because of earnings going up, which is the blue color. They went up because the rates went down. This year, we're actually seeing rates go up. So 2021, we've seen the reverse happen where the multiple is starting to hurt valuations, but it's been more than replaced by earnings, which is the blue color here. So it's really important to watch interest rates, because if interest rates go up too quickly, which would happen if inflation and the economy got too hot, you're going to see even more of this orange dragging valuations of stocks down. And so that's a risk to the stock market. You could say it might pop the bubble of stocks, or it might at least slow down their price growth. The flip side is ironically the total opposite. It's a slowdown. And the slowdown would obviously be caused by what's still out there, which is COVID. In the US, we've seen a really significant fourth wave of COVID. Principally, it hasn't happened in a lot of the rest of the world because the US, despite getting vaccinations out almost first in the world, has been really slow to get fully vaccinated. And the anti-vax movement here, and especially in some states in the South, has been pretty hesitant to get people vaccinated. And that's where the new wave has actually happened. But the data showing that there's a new wave, showing that there's an increase in hospitalization, showing that thousands of people dying per day has changed consumer behavior already in the US. And so we can see already in the US data, confidence is falling, which is this chart on the right. In some measures, confidence has now fallen right back to pretty much decade lows, almost, well, below where we got when we saw the first COVID shock. And so the consumer isn't spending as much. They're not going to restaurants. They're not booking holidays and going to hotels and on airlines. And so that services sector employment is going to wind down as well. And so that's a big risk to the economy, because the multiple effects in terms of people losing jobs or just not getting new jobs, and just the gap in terms of now we don't have stimulus, what's going to happen with all those people that are unemployed? Because there is still millions of Americans that are unemployed compared to who were employed before. And so there's a risk of a slowdown, I think, as well on the tail side. That's why we look at COVID so carefully. But ironically, we've just talked about the two tail risks, and they are opposites. So where we are right now is in a little bit of a Goldilocks zone where rates are low, the recovery is strong, retail spending is good, employment is improving. What economists are watching for is a movement either direction. So whether the economy overheats, which means that interest rates are going to go up, which is a headwind to stocks, or whether the economy needs to be cooled, well, gets cooled down by COVID, where through global supply chains, if emerging markets have a spike in COVID, we've already seen in Vietnam and some of the Asian countries with their first wave of COVID, some of the supply chain getting shut down. Or if the developed markets have another wave of COVID and quarantines, if there's another variant that gets around a lot of the vaccines, we could see a huge hit to GDP again, and a slowdown, which would not be good for stocks. We saw what happened 18 months ago. So they are the two tail risks. They're opposites, but it's just something to keep in mind considering where we are right now. And with that, Joy, I'm happy to answer a few more questions.
Thank you so much, Phil. And with that, we will start our Q&A session. So a viewer said that he read that Reddit users are seeing themselves as fighters against the Wall Street insiders. So can you comment on that, probably?
Yeah, I mean, that kind of comes back to the fact that the meme stock frenzy is a social media driven phenomenon. And that's where I think the regulators are a little concerned, because investors that are buying the stocks on a fundamental, probably fundamental's the wrong word because fundamental sounds like valuation. But if they're buying it based on idealistic views, because they want to stick it to the man, or hurt the short sellers that are hedge funds or whatever, then they're not concentrating on valuation, and that could lead them to be the last in at the top and buying high, selling low, losing a bunch of money. There's been a few discussed examples of people that have lost a lot of money joining the meme rush too late and getting out when the frenzy goes away. And you can see from some of those price charts early on, the price spikes do tend to come back down, and they come down sometimes very quickly as well. So any investor getting into the meme stocks has to be quite careful about where they're buying in the value proposition and being able to get out quickly enough if things turn around, because they don't want to be holding the stock long term if it's going to be falling for a while.
Thank you for that. And without betting on meme stocks, let me say that again. Without betting on one or two single meme stocks, are there any ETF or funds to play this phenomenon?
You know what? There may be a meme stock ETF already. I know it's been discussed. I honestly can't remember if it's listed yet. But I think what's interesting is just watching some of the thematic plays that we've seen as well. So there are now in the US over 2,000 different ETFs, and most of them are pretty liquid and pretty well priced by the market makers. So like we saw, people were getting into things like online retail or innovative funds or oil drilling, airlines specifically. I think you can do some thematic trades based on what your view is of fundamentals, which still have a lot of exposure to the view you're trying to express without specifically being the meme stock complex. A lot of the meme stocks are actually really quite small cap stocks. So typically ETFs try to keep less liquid stocks out of ETFs just because they add to transaction costs in the ETF, as people are trying to do the arbitrage for the ETFs as well. But the thematic ETFs have definitely had a lot of interest in the last, not just the last 18 months, but the last 4 or 5 years. There are more and more smart beta ETFs in the US as well, where you can position in things like momentum, value. If you think that interest rates are going to go up, typically value starts to outperform because growth underperforms because it's outperformed so much as rates have gone down. So there's a lot of different, I guess you could say, bets you could make on specific COVID recovery or interest rate inflation factors driving markets. that are not so related to meme stocks, but more concentrated on a view.
Thank you so much. And a viewer also wants to know how he can identify a meme stock run and probably avoid it.
Yeah, I mean, the reason I showed that chart where we looked at stocks that had rallied 100% in a week, what was interesting when we looked at those stocks, though, is a lot of the time the stocks that rallied that quickly had a news event before the rally. So they had earnings, or they had an acquisition, or they had a drug that had got approval for distribution. Like, they had some really positive news, which meant that the stock fundamentally should have better earnings in the future. And so the valuations, and you can see from the sort of 6-month, 12-month future valuations, they held those gains because the company was going to be more profitable going forward. So I think if you're looking at, I mean, if you wanted to set up a screen, you just want to look at the volumes trading in a stock versus its normal volumes, because you can see from the levels of activity, the meme stocks trade just an incredible amount of stocks. There's such a concentrated burst of interest in those tickers compared to normal. But I think more interestingly, so that you don't get caught, would be to say, when I see a burst of activity, when I see a price rise because of that burst, or a fall if it's already been up, is there news that justifies the price rise? You know, does it actually fundamentally change the valuation of the company, or does it look like it might be less informed investors and potentially a risk to be involved?
Thank you. So another viewer wants to know what your intake is on the theory that Citadel, I hope I pronounced that right, and others were using the seller boxing strategy on meme stocks like AMC and GME and are now in trouble due to stable interest in the stocks and probably soon increasing the interest rate.
Right. So the way that the US market works is Citadel, Virtu, there's a few market makers that we call wholesalers, and they actually interact directly with retail flow. A lot of retail flow doesn't actually come to the exchanges. So a little bit more like the options market, when a whole lot of retail buyers come into the system, those market makers end up short the stock, which means they have to eventually go hedge. What they're hoping for is, most of the time retail buyers and sellers come sort of alternately, and they get to capture a little bit of the spread. When there's a wave of net buying, they obviously end up with a lot of single stock exposure, single stock risk. That's not their business. They're trying to provide liquidity on two sides of the spread for all the stocks in the market, and so they will try to exit their position and hedge their position, which would have made them turn buyers. But there's been no data that I've seen that says that they were positioned in those stocks before the spikes happened. And just given the first question that we got, I mean, it really was quite hard to see this coming. Shorts had already mostly reduced positions. So the fact that this was turned on in January as a short squeeze on a select number of stocks was a little bit unexpected. And I don't think that many of the market makers would have expected the scale of it either. They would have pretty quickly, even if they had some position or some inventory, been wrong on it and had to be hedging themselves too.
Great, thank you. And another question from the viewers was if you think that the total value of the market taken up by retail investors investing in meme stocks could rise.
So that's a really interesting question. I mean, you can see the impact of free commissions, the accessibility that apps have given retail investors. If we kind of go back 10 years, retail have much cheaper trading in the US, much easier access, opening an account, funding it. The internet and technology has just made investing in stocks so much more accessible, which is great. So a lot of people are self-directing and using their retail accounts to invest in stocks. I think where we are right now, with retail being 25% of the overall market, is a pretty significant percentage. If you look at retail investments in stocks as a percentage of assets, they're probably about a third, a little bit more, and mutual funds are about a third as well, and then international investors and banks and all the market makers kind of make up the difference. But So they're getting close now in terms of their liquidity matching their assets. And typically, if you look at retail investors, they are mostly pretty low turnover. They buy and sell maybe 12 times a year on average, sometimes even less. So they tend to buy and not really trade that much. So I think, and maybe this is an important factor talking about the meme stocks, is it's not all retail that are buying into the meme stock and making the stocks do what they're doing. It really is, the meme stock itself is a social media driven subset of the retail universe that do trade very actively. The broad retail complex is still much more passive, much more buy and hold. They like ETFs if you look at what they tend to trade, and they turn over an awful lot less.
Thank you for that. So Phil, what's your opinion about the probability of the two tail scenarios kicking in? Meaning, won't the Fed be forced anyhow to take interest rates up?
Yeah, I guess my probability changes on a day-to-day basis based on the new data that comes out. And the reality is, because COVID was such an unusual shock to the system, and because the stimulus is, I mean, it literally is multiples of most recession stimulus spending. We're talking about world war levels of stimulus and rebuilding going on. And so huge amounts of debt in the system, huge amounts of stimulus, kind of, I mean, people say unprecedented, but it really doesn't fit with a lot of the historic recession recovery. So it's difficult to see a single data point and say, oh yeah, that fits with my view, and then the next data point fits with my view, and so the probabilities stay the same. I think when you see, like this week, we're starting to see in the US, the new cases of COVID are slowing down. They're sort of stabilizing at current levels, which typically means COVID's actually likely to get better in the short term. That's a really good thing. But that might also mean that people go back and start spending again. But that itself might mean that the employment situation gets better for all of those service, leisure, and hospitality and people who, now that school's back, actually probably want a job. And now that the stimulus has stopped, probably want a job. So there's so many moving parts right now. And it's a little bit of a jigsaw, I think is the short answer, that you see one piece of data and you sort of need to put the jigsaw puzzle back together. Does this mean the market will go overheat, or does it mean that the market might actually have to stall out to get over COVID again? So really focused on the risk factors and the data points. Having said that, if we look at the last 3 or 4 months, I think the industry is starting to discount both tails, because it seems more and more likely that we've learned to live with COVID. The vaccines are pretty successful. Even some of the hospital treatments are pretty successful, and so you don't need to shut down the economy. And on the upside, especially some of the inflation data we got this week does make it look like we won't see a persistent increase in retail demand, pushing inflation in input prices. As we go forward, we might actually see that pivot to services, more employees coming back into the market, and what the Fed wants, which is transitory inflation, which allows them to get back to normal interest rates much more gradually.
Thank you so much, Phil. And that was our last question for today.
You're welcome.
Give me a second. So the technique does what I wish it to do. Perfect. Great. So as I said, our online seminar must now come to an end. Thank you so much for your presentation and the detailed answers to the question in the Q&A session, Phil. I think we learned a lot about meme stocks today.
You're welcome.
Before I come to a little conclusion, I would like to point out to you, dear webinar participants, that this webinar was recorded. An article with the recording will probably be available during the evening on the finanzen.net homepage. You will also receive the link in an email. And Phil, what is your conclusion about our event today? What would you like to tell our participants?
I mean, I think the meme stock craze is kind of interesting to look at, but if we think about the fact that retail investors are getting into the market, and that's a good thing for their financial security, I just hope that retail investors also realize valuations are important and diversification is important, because it's in everyone's benefit for us to have a secure financial future.
Thank you so much for being our guest today. I hope we will meet again in the finanzen.net seminar in the future. I would be really happy about that. I wish you a nice day and all the best. And I would also like to thank you, dear viewers, for your active participation today. With that, I say goodbye. I wish you a nice day and good luck with your future investments. Und damit verabschiede ich mich auch nochmal auf Deutsch. Ich wünsche Ihnen viel Erfolg bei Ihren künftigen Investments. Ciao, machen Sie es gut und bleiben Sie gesund.